The Federal Reserve has concluded its most recent meeting, and there is one key sentence that changes everything about the outlook looking forward here. We know that the Federal Reserve has been very, very intentional about signaling its future moves far in advance of actually making them. This is how they've operated for at least the last few years. We all know in the beginning they said, we're not even thinking about tightening. And then they said, we're thinking about tightening at some point in the future. And then they signaled, hey, we're going to start tightening at some point in 2022. And then it came around, they said, we're going to start selling assets. We're going to raise interest rates. They've been very clear far in advance what they are planning on doing in the future. And now they just gave the very first real indication of a slowdown in tightening. Let's take a look. So this is their press release from earlier today, and we are going to hone in here on one sentence that is brand new. And keep in mind, when I say brand new, this is something many economists pay attention to regarding the Fed, because when they change something in the statement, many times the statement is virtually identical to the last meeting's statement. And then every once in a while, they'll change one word, they'll add a word, they'll take away a word, things like that. And so whenever there's like a full new sentence that's very different from anything they've said in the past, that is something to pay attention to. So we can see here, it says, in determining the pace of future increases in the target range, so that's the Fed funds rate, the base interest rate, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So there are two things that we need to look at here. The first thing is cumulative tightening of monetary policy, and then the second thing is the lags with which monetary policy affects economic activity. So it is very important for the first part that they are going to be taking into account now the cumulative effect of their tightening. So they're not just saying, hey, this last 0.75% move in interest rates is going to have this effect. They're now starting to look at what is the cumulative total impact of everything that they've done so far since the start of this year. So we can see here, if we look at their balance sheet, they're saying, hey, we need to take a look at all the money we've sucked out of circulation by letting these assets bleed off of our balance sheet here. Now, just so that you're aware, the way that this works when they let their balance sheet decline is money comes out of circulation, because when the Fed adds to their balance sheet, when they buy assets, what they are doing is adding dollars into circulation. So they create new dollars out of thin air, then they go out into the marketplace and say, hey, does anybody have any assets they want to sell us? And then all the banks raise their hand and say, yeah, we've got some assets. We just made some loans to the US government and we don't want them anymore. We don't want the US government to owe us money anymore. So instead of selling them to somebody else on the open market, Fed, would you like to buy them? And the Fed says, absolutely. Let's print up some money. I'll give you the cash into your account. You give us that debt. So now the federal government owes the Federal Reserve dollars instead of Bank of America, let's say. And so that adds new dollars into circulation because they're printing money to buy those assets. And so that adds to the total supply of money. So when we see this, which is the opposite, we see the money supply is actually going to be decreasing, because as they let assets, these bonds mature, they're not rolling them over. So that money is getting paid back to the Fed by the federal government, and then it ceases to exist. It cancels out. And also, when they sell assets off their balance sheet, they are going into the marketplace and saying, hey, does anybody want these assets? And Bank of America might raise their hand and say, yeah, we'll buy that from you. So dollars leave Bank of America, go to the Fed, and then again are destroyed here. So the Federal Reserve creates and destroys dollars that go in and out. And so when their assets on their balance sheet are declining, the number of dollars in circulation are declining. All else being equal. There are other factors as well, but that is the effect of their balance sheet. And then similarly here, we're seeing the Fed funds rate, this chart going back to the 60s of the federal funds rate. When interest rates are rising here, we can see they've been rising since March of this year. We can see that now the Federal Reserve is paying attention to both the effects of interest rates going up and the effects of their balance sheet declining. And interest rates going up have a similar effect on the money supply. When interest rates rates go up, debt gets harder to pay off. Even if you're not adding to the debt pile anymore at that point, your payments will go up if you roll over that debt into new debt. And so debt gets more expensive to continue paying and to continue servicing. So the incentive is to pay off that debt so that you lighten up your expenses. And so when interest rates go up, the money supply goes down, because just like the Fed, banks are able to loan money into existence as well. And so when you swipe that credit card, that money that goes into the grocery store's bank account didn't exist before you swipe that card. That means when you go to work, you get your paycheck, you suck money out of circulation and you pay off that credit card, that money ceases to exist now. Just as it was loaned into existence, when it's paid off, it ceases to be in existence. And so when interest rates go up, it has the effect of lowering the total supply of money. And that's why when we look at the total money supply, it has not changed this year. And in fact, since about halfway through this year, it's been on a little bit of a downward trajectory here, and it looks like it's about to fall off of a cliff here. Right around August, it started to fall, and then in September, it fell severely there. And so it looks like after the next month, 2 months, we're going to really start to see the money supply start to drop as a result of monetary policy. So the Fed is saying we have to start taking a look at the cumulative impact of everything that we've done. We can't just look at what we're doing right now, what inflation is right now, what the jobs market is right now. We have to start taking a look at everything because of this is the next key, because of this second part. This is the second part of the sentence that they added: the lags with which monetary policy affects economic activity and inflation. This is something many people do not pay attention to. This is something that's been known for hundreds of years. It's called the Cantillon effect. This is discovered by Richard Cantillon, however you'd like to say it, I don't care. And he was participating in the Mississippi bubble that John Law caused. John Law was the central banker. He created the Bank of France in France 300 years ago. He created the Mississippi bubble, got everybody's gold and silver, printed a bunch of paper dollars, caused a big bubble, caused a bunch of hyperinflation. Richard Cantillon was the one who discovered kind of this effect, and he got very rich as a result, because when money was getting printed through the roof, he started to buy gold and silver. And so he exchanged his fiat money for sound money and became very rich as a result. And he noticed this, and people have noticed since then, that there is a giant lag between monetary policy and economic activity. Basically, when you print the money, it's not going to cause the inflation immediately. And when you start to decrease the money supply, it's not going to cause deflation immediately. Asset prices, though, respond very quickly. This is why when you take a look at the timeline, we can go back to March of 2020 when this whole shit show started, and we can see that in March of 2020, when they printed trillions of dollars, the stock market popped immediately. Real estate prices start to skyrocket immediately. Asset prices respond very quickly. And so you got the boom. And then after a while, we're going to take a look at exactly how long, then inflation hit goods and services. So this is how money works its way throughout the economy. First, that new money hits assets, then it hits goods and services, and then the last place it hits is wages, which is why savers and wage earners are going to be the worst off from inflation, because they're the ones that have to pay all those higher prices along the way before they ever get their new money. It's the rich who are able to buy the assets and who use debt, who buy the assets first, get rich, and then they don't care about their wages because that's not what they're relying on. They don't care about their savings because they have none. They're in debt to buy assets. And so they're the ones that benefit at the expense of the poor. And that's why the rich and the elites always prefer inflation over deflation, and why every time you read about all these Nobel Prize winning economists and all of the people at the World Economic Forum and the IMF, they all favor inflationary policies over deflationary policies because it helps them out at the expense of the rest of the population. So how long exactly? Well, let's take a look how long it takes for monetary policy to hit the overall economy, not asset prices. This right here is a chart from the BLS of inflation, the inflation rate. We're going to zoom in here. We're going to take a look. I'm going to use 2016, 2017, 2018, 2019 as the baseline. I know that these are not accurate inflation numbers, but what we don't need accurate here. We just need consistent. And so the methodology for measuring has been consistent for at least the last 6-7 years here. Minor changes, but nothing significant here. So I'm using this as the baseline, around 2% for the years prior to 2020. Now we had a drop in the inflation rate in 2020 when they started printing a bunch of money. Keep in mind, April, May 2020 was the bottom of the stock market. Actually, I'm wrong. It was March of 2020. So immediately when they printed the money, we started to see asset prices skyrocket. We had already reached a new record high by just August of 2020, just a few months later, and it only went up from there until the end of last year. So the new money hit asset prices immediately and had a huge effect right away. But how long did it take for the inflation rate to come back just to baseline? Just to come back to baseline, it was March of 2021. That is a year later, just for the inflation rate to reach baseline again. And if we want to take it one step farther, there's a huge argument to be made that even getting back to baseline wasn't enough to overcome when you talk about, I know I'm not saying good or bad here, it's actually bad. The less inflation we have, the better, the more deflation we have, the better. But you could make an argument that even coming back to baseline wasn't the full effect of the money printing because you have to overcome the drop in inflation that happened initially. So you might be looking at April or May of 2021 before the money printing that happened over a year earlier had its full effect. So we can see here that it takes a long time for newly printed money to hit goods and services. It takes a long time for that to impact inflation. When did the Fed start to tighten? Well, their balance sheet didn't actually start to decline until March or April. Now, a lot of that was mortgage-backed securities take a while to hit the balance sheet from the date of the purchase, but still, it topped out here around March or April at the earliest you could say at the beginning of 2022. When you look at the interest rates didn't start going up until early 2022. So while asset prices have already factored in, they've already priced in all the tightening, or not, maybe not all the tightening, but as long as it goes according to what the Federal Reserve has been signaling, most of the tightening has been priced into many assets already. However, that has not happened to goods and services yet. We've still seen inflation. Inflation is still at multi-decade highs. Regardless of how you measure it, it's still at multi-decade highs. How long has it been since the Fed has been tightening? It's been 7 months, 8 months, 9 months, maybe? We know that when they started to ease, it took at least a year for inflation of goods and services to see the results of monetary policy. There is a lag between which monetary policy reaches goods and services. It hits asset prices immediately, and that's why when they eased, stocks popped, and when they tightened, stocks dropped immediately. But it takes a while, usually about a year or more, before it hits goods and services. So the Fed has been tightening for almost a year now. This is why I don't understand why people lose their minds when I'm saying that the Federal Reserve will be successful in causing deflation. It just takes a long time for it to happen. And they're continuing to tighten even though they know that. And they know that. They've talked about this before. You can go find speeches from Powell, even 2018 and 2019, saying there's a significant lag, sometimes a year, up to 2 years before monetary policy hits the overall economy. And they're just now starting to recognize this in their official statements. So deflation is coming. On average, the prices of goods and services are going to start dropping very soon here. And yes, it will be very painful for many people, probably most, because when the price of products starts to drop dramatically, guess what happens to the companies selling those products? Their profits go down, they start taking losses, and who's the first person to go when companies start taking losses? I'll give you a hint. It's not the decision makers. It's not the people who are in the ability to choose who gets to stay and who gets to go. So within the next few months, we are likely to see the Federal Reserve start to run victory laps as people lose their jobs. So cash up, be ready. Discounts and sales are coming. And if you want the best system out there on how to identify the best companies in the world and figure out whether they are actually at a good price yet or not, get my bear market investing guide, only $99, linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.